Welcome to our weekly investment update. It's Thursday the 7th of May. My name is Chris Marshall. I'm Head of Investment Strategy here at Dragon Investment Managers. And as we do on a weekly basis, we really wrap up what's been happening in the markets over the past few trading sessions, as well as look at some of the salient points coming out from the land of economic data. So as we look to markets, Thursday's early morning trading in the Asian countries and region really kind of was a little bit mixed. We did see some positive sentiment come out towards the end, which is really China coming out with higher than expected exports than the market was predicting, and this is really kind of pushing the futures for both Europe and the US up slightly. Over the past week, we've not seen the same momentum or volatility in markets generally, and most markets have managed to put on a marginal amount of weight over the past few trading sessions. Of course, in the UK, London market will be closed tomorrow, but most of the world markets will continue to be open through Friday's trading as well. So there is still a couple of trading sessions ahead for the week. If we look to some of the economic data, I think really as expected and as people are becoming more and more aware of, the economic damage from the government's policy to really retard coronavirus through suppression of social and economic activity has a devastating effect on the underlying economy itself. We've seen a kind of a report come out yesterday from one of the payroll processing companies in the US suggesting a job cut rate of about 20.2 million for the month. This would be the highest on record, and really kind of all eyes will be on that Friday's official labour report, which is expected to reflect the number. To put this kind of in perspective of what a 20 million job loss would be in the US, we have to go back to September 1945, just as, of course, the US was really demobilising after World War II. And at that point, the highest job loss was 2 million in a single month. Now, of course, US population has increased, but not significantly enough to account for that difference. And it's a very similar story if we turn our attention to Europe. Of course, we've seen a very different policy action between US policymakers and EU lawmakers. EU favouring employers trying to keep employees on the book through a sense of payroll support, furloughing, US going for higher unemployment benefits. And really within Europe, we're seeing a figure of about 40 million workers being furloughed, and really kind of the concern for us is how quickly do those workers come back online, how quickly can the economies reopen, and really kind of stave off long-term unemployment, which is a very, very bad thing for economies over the near term if we were to see very high unemployment levels carried through. Again, if we look to other areas of the market, we're seeing this really pull through in surveys such as bull-bear ratios. So we've talked about these in previous weeks. Really the ratio of the number of people in the market, or at least the number of people surveyed in the markets, thinking that the markets will go up from here compared to the number of people who think it'll go down from here. So when we have a negative bull-bear ratio, it's essentially saying there are more people surveyed who think markets could tumble from here or fall in some way than they think will rise. And really we've seen this negative sentiment from this ratio pull through from really kind of the end of February, after that February 16 massive sell-off that saw that rapid ride down, 22 trading sessions and 30% down on some of the indices. So as we kind of look to this, we also have to tie into this that we've got massive central bank action, and we'll touch on some of the things which are going on in the land of central bankers. But of course, while you're seeing these worries come through, as well as massive monetary debasement, which of course is essentially what fiscal policies and central banking policies currently are doing, they are debasing fiat currencies, that is currencies not backed by a physical asset, as we've had in eras gone by. And we're seeing, of course, gold rally on the back of this, as we would expect. So gold's up about 30% over the past 12 months. And really this is just baking in investors trying to price in, well, how much uncertainty is left in the market and where do we think inflation might be going. Of course, grappling with the idea that we could see some form of financial repression, perhaps in terms of yield curve control, which of course Japan led the way, is not unknown to both the UK and US and Europe after world wars and very high government debt levels. So as we kind of turn attention to central banks, we've seen the US continue with open market operations and asset purchase programs. So the balance sheet on the US Fed we've seen rise from about $4 trillion in the early part of March, now to about 6.5 trillion US dollars. That's a representative amount of about 12.5% of US annualized GDP, and they're not really showing any signs of slowing down just yet. And this is really, as we've explained in previous weeks, putting floor under the market, giving some confidence and making sure that the financial system is at least operating in some form while governments are suppressing economic activity. If we look to ECB, of course we saw the German Constitutional Court come out with a very harsh accusation against the EU Court. EU Court is of course meant to have supremacy in Europe. Really the German court saying that they believe the EU Court overstepped their powers when they were supported some of these controversial bond buying programs in 2015. Off the back of that, we saw ECB come out quickly saying, well, we're not changing our stance. We've noted that ruling, but we believe it's lawful, and we'll continue with really the whatever it takes in the current environment anyway. The euro did tumble off the back of that, and it hasn't really recovered. We also saw Italian bonds fall, really not just off the back of the German court ruling, but also the outlook for Italian, Spanish and Greek economies, which a report saying that they could see their economy shrink by around 9% in 2020. So let's turn to some of the positive news, why markets aren't falling. According to all this economic data, I think probably one of the good indicators for really capturing the sentiment of the market is the rally back up in oil prices. We've now got West Texas Intermediary, WTI, at about $24 a barrel. We've got Brent at around $29. It was up at 30 a few hours ago. It's still down over the month, but we're up about 20 to 25% depending on which oil index you look at over the week. And this is really kind of baked off, as we said, exports coming out of China, as well as investors starting to look at hopefully a pickup in demand as we see economies really start to reopen now. So, of course, yesterday or early in the week, we saw Italian workers come back into the workforce. So they reported about 4 million workers came back to work this week. More are expected as the lockdowns are eased in Italy. We've seen Germany come out announcing that they now feel they're in a position really to reopen most aspects of the economy, which is very positive, of course, for all those businesses and workers. Britain, of course, we could be announcing an ease to lockdown on Monday, according to some reports out recently. And when we look to the US, if we look around the US map, it's a very pleasing sight to see that a lot more states are now in a state of either partial reopen or about to open soon, even compared to just a few days ago. So there does seem to be this momentum of businesses coming back online, workers coming back into employment, and hopefully we'll start to see that recovery process really come through. But I think that the underlying tone has to be that the easing of a lockdown is not an event, it is a process. And perhaps we're going to have some volatility in markets as investors really grapple with that fact. So that's kind of a wrap-up of all the things that we've seen going on this week. So it's Thursday, but it's a bank holiday in the UK tomorrow. So from myself and all the team at Dragon Investment Managers, we wish you a very healthy and happy weekend, and we'll be back next week with a roundup of markets.